Good morning. Good morning. I'm Marshall Clement, the Director of Sales for Long-Term Care Planning at GP Agency. And this morning we're going to dial in and zoom in on Thrivent, which is a wonderful company that is a fraternity. And we have with us Melanie Hertz. Melanie, I forgot to ask you, do you pronounce it the same way, the car company?
I do pronounce it just like the car company. Yes.
Great. Great. Melanie resides in a cold place in North Dakota, in the central part of North Dakota, and she's with sales support and training and development for Thrivent. This morning, she's going to go over the traditional plan. I love the Thrivent traditional plan for a couple of reasons. You can have a very robust benefit for those who want 15,000. They'll go up to 15,000 a month in benefit, and that's very helpful for places like Boston or New York, where the cost of care is very high if you've got clients there, or somebody that just wants a very high benefit. And they have a lot of riders for those that want to customize and have a very robust plan. One of the real strong things with Thrivent also is that they have pristine financials. They have top ratings with all the rating agencies. I think last year their Comdex was 100. It seems to go from a 99 to 100 from year to year, which is of course pristine. So if you've got clients that you're competing with that may want to go with Northwest Mutual or Mass Mutual or some of the other higher rated companies, we can certainly offer a high rated company in Thrivent. But I'm not going to steal any more of Melanie's thunder. This is Melanie Hertz with Thrivent. She's going to go over the product and give us some more information about it and why we like it. So Melanie, take it on from there.
All right. Well, good morning. Thank you so much for being part of today's presentation. We're going to run through what I'm calling Thrivent's traditional long-term care differentiators. We're going to cover a fair amount of ground and really try to get you some key pieces that we'll discuss throughout the presentation today. When it comes to offering your clients a solution, I think today's consumers, they're looking for strength and they're looking for stability. And yeah, when besides the strength and stability, we've got an extremely competitive solution that you have available to you, and it's backed by the the country's largest fraternal insurer. We're going to start out just doing a little history in long-term care, and then, of course, dive right into our differentiators. Couldn't do a presentation without mentioning that this presentation is intended only to educate you, as broad in scope for training purposes, and does not consider your client's individual personal financial situation. Your client's personal financial situation is unique, and the information and advice does not need to be is not suitable for all situations. All right. So, who is Thrivent? We are the world's largest fraternal organization. Now, I'm coming up on 20 years in the long-term care arena. And I started Thrivent about 6 years ago, and kind of took me a little bit to wrap my brain around a fraternal. So I'll tell you the easiest way to remember it. A fraternal organization we're a not-for-profit organization where all of the members share a common bond. With Thrivent, the common bond is that our members are Christian. You might remember it used to be Thrivent Financial for Lutherans. Membership was actually opened up to all Christianity in 2014. A simpler way to think of Thrivent is that it's like a financial cooperative where all of the members or policyholders are owners. We are not a stock company. I think it's very, very important to know that we are not beholden to stockholder interest every 90 days, much more like a mutual company in that regard. But unlike a mutual, for our not for profit, tax exempt fraternal status, we are required to give back to our communities. As such, we are the country's largest supporter for Habitat for Humanity, and you'll likely see people in our Live Generously t shirts working on different service projects in the community. Um, all of those projects were funded in some way by fraternal dollars. At the end of today's presentation, I'm going to wrap up talking about our common bond requirement and really how to give you a clear understanding of how to position Thrivent as an option. We don't always know if our clients are Christian or not, and it is something that you'll hear me talk about this later, and I'll try not to be too repetitive, but we get asked if you have to your client has to attest to being a Christian when they apply for a Thrivent solution. And what I would say is that I would not wait till the point of the application to ask or verify if the person that you're working with is a Christian. um, we get asked a lot if, when we go through this slide, do you ever think that Christian requirement will go away? I don't think it'll go away. I think that it's the core of who we are as an organization, and it's kind of what's gotten us our strength of who we are. So I don't see that going away of who we serve changing at any point. um we had talked about it a little bit, but our ratings are pretty tough to beat. With AM Best, that A plus plus rating, we have been named the world's most ethical company for over 10 years now. Um, we are one of the top three highest rated carriers, um, and we, of course, are available to independents. Like Northwestern Mutual, of course, is captive only, as is New York Life. So Thrivent has been around for a long time. Are they new to long-term care? Well, we began as two separate fraternals, Aid Association for Lutherans and Lutheran Brotherhood. Both began selling their long-term care solutions in 1987. It was back in 2001 that they formed Thrivent Financial. It took a little bit to get our long-term care solution of our own on a Thrivent brand compiled. So in 2012, we re-entered the market with our own product. We are now on our second generation long-term care solution, which was launched in 2016. That's where we get asked a lot of questions. Well, isn't there going to be a reprice anytime soon? No, we are very happy with our solution. I would be very surprised to see a reprice on our solution on the traditional side in particular in this year. Um, we launched our linked benefits solution last summer. Care Forward, we're going to learn more about that one tomorrow. Um, we believe in this product so much. It's something that we want to solve for our members. So we feel like we have best in class solutions, not only on the traditional side of the house, but on the linked benefit side of the house. One of the biggest benefits that I would say we have is we have over 30 years of experience in long-term care solutions for our clients, and maybe not the baggage that comes along with missteps carriers made, um, underwriting, other assumptions on those blocks in those early 90s and 2000. If you look at like Aid Association for Lutherans, they were formed in 1902. Lutheran Brotherhood began in 1917. The home offices for those two companies were in Minneapolis and Appleton, Wisconsin. To this day, Thrivent is in both of those locations. So you've got deep roots that go back well over 100 years. One of the elephants in the room when it comes to traditional long-term care, I think rate increases have been uh, the elephant in the room. Um, so you can see that uh, we have had a rate increase. It was once, and this is on in-force business, I'm saying. It was back in 2004, pretty conservative. A lot less than what you've maybe seen for companies that were stock owned during that exact same time frame. To be very, very clear, there have been no rate increases on existing business on a Thrivent branded product. Again, those have been started being sold in 2012. Okay, our partner for long-term care, LTC Group, of course, just went through a rename, same team, um, as good a service or better. Lots of great things coming there. A lot of companies use this partner, and we're proud to have partnered with them as well. They they do a lot of work with a lot of other solutions. So you'll find this to be very seamless, really, really good support all around. When just real quickly here, I'm going to just run through a few key differentiators. One, of course, is the issue ages. We are the solution that's going to dip down to age 18 and go all the way up to age 79. We have a 5-year rate guarantee built into our traditional solution. That first day home care. I'm jumping ahead. Oh my. Our elimination period is a 1 = 7. So you have the benefit of a calendar day elim, kind of, without the sticker price for it. Definitely better than just a straight up service day elimination period. We'll talk more about that in a minute. We can go up to an 8-year duration, up to a $15,000 monthly maximum benefit. I will spend a little bit of time on our FIB, the flexible increase benefit. This is an inflation guard, a very cool inflation guard to get into different price points, little bit more flexibility. I could probably do an hour-long session on the FIB. I'll try not to put you guys to sleep today. We also have just a straight up 1, 2, 3, or 5% compound inflation. And you can also do a 10 pay on our solution and a whole slew of riders. We'll talk about some of these and in just a minute here. So when you think about Thrivent, think comprehensive, as you would hopefully expect in a modern, traditional long-term care solution. Thrivent covers services in a variety of settings: home care, residential facility care, adult daycare. It's got the alternate plan of care built into it. Our policy is a reimbursement model. Uh, we are obviously tax qualified. It's been filed for partnership in most states. Here's something that in your neck of the woods, I'll make a point to bring up. We have a partnership qualified solution in Indiana. You don't have to write partnership in Indiana, but we do have a partnership qualified solution there. And we are in with our traditional solution, we are in every state except New York. All right. Built into our solution, we have the waiver of premium. Once you trigger your elimination, or once you trigger your claim and the elimination period has been satisfied, your premiums are waived. If you are working with a couple and they have shared care, uh, this is really cool. It's going to be a joint waiver of premium on the solution because the joint waiver is technically built in to the shared care rider. You can't buy a joint waiver separately. It's built into the shared care rider. I do really like our care coordinator services. You don't have to use them. Okay. Make no mistake, you do not have to use a care coordinator. And if you do use a care coordinator, it's not going to reduce the value of your policy. But it can be really game changing for people at the time of claim. You know, you might think that I know a lot about long-term care. This claim is going to be a cakewalk. I want to be in charge of everything. It really is really nice to have a care coordinator tucked in your back pocket. We also, of course, offer our bed reservation for up to 60 calendar days, which is kind of an industry standard, I guess. As far as the alternate plan of care, I touched on this a little bit ago. I can't help but not at least mention it, especially to help. This is going to be a game changer for as you target your younger clients. I think that services and technology in the way care is provided is certainly going to evolve. Um, if COVID did anything for this industry, it it put a microscope on it, and people realized pretty quickly they didn't want to be institutionalized in a nursing home. And let me tell you, these solutions, they're never meant to dictate how or where you receive your care. It's here to pay for it. You're still calling the shots. I think that's important to call out. Uh, and with this alternate plan of care baked into the solution, it should make you feel like you'll have a little extra flexibility there. The contingent non-forfeiture benefit is on the solution, and you know, up until the CARES Act, I felt like I pretty, unless we were working with a business owner way back in the day, I just didn't feel like there's a ton of value with a contingent non-forfeiture benefit. But you know how it works. If you lapse your policy after having it enforced 3 years or more, whatever you've paid in premiums, you can use as benefits. This uh, the contingent non-forfeiture is baked in. The non-forfeiture rider that you can oh, I just misspoke. The non-forfeiture rider that you can um, uh, tack on is very inexpensive. This contingent non-forfeiture is contingent on a rate increase, and of course, baked into the solution. No charge for it. If your policy does have a rate increase, whatever you would have paid in premiums, you can use as benefits. All right, let's talk the ancillaries. So you've got respite care, the home modifications, caregiver training, and international care benefit. For each one of these benefits, it's going to pay out 2 times the monthly maximum, and it's gonna pay out. That's the payment for the life of the contract, and it's that's true except with respite care. With respite care, it's going to pay 2 times the monthly maximum benefit once a year. For all of these others, it's going to pay 2 times the monthly maximum for the life of the solution. So what does that mean? It means that international care, that benefit is pretty light, right? It'll pay, but for only two times the monthly maximum benefit. So basically enough time to get back into the country. Uh, when we talk about our uh, building blocks or the components, the first thing that probably matters most is how much this policy is going to pay each month. 1,500 to 15,000 in $100 increments. You, if you're rated up to a class 1 or a class 2, it does not restrict your monthly maximum benefit. It's a big deal. If you are your how long, how much it's going to pay, how long, those are the 2 things your consumers care about most, right? Um, if with our solution, you can do a 24-month, 2-year, 3-year, 4-year, 5-year, or an 8-year duration. When you are rated up to a class 1 or a class 2, we are not going to restrict the number of months / years that this policy is going to pay out. That I think is really important. The elimination period. So you can get a 30, a 90, or 180-day elim on this solution. It is a 1 = 7 elimination period, which is going to kind of come into play for home health care. If you're not receiving care every day a week, this is really handy. Receive care just 1 day a week, and it'll knock out 7 days of your elimination period. You only need to satisfy that elimination period once for the life of the policy. And then the other big thing, how do you get it to keep up with time? So as I alluded to before, you could do a 1, 2, 3, or 5% compound inflation option. Those are simple. 3% compound is sold 62% of the time today. Very much a sweet spot for our solution. It's going to grow for the life of the contract, even when you go on claim. Um, and um, and it's just very, very competitive. Other solutions have repriced. Ours has been priced since 2016. So we're just very, very well priced. I don't like to put a ton of weight on it being very competitively priced. The thing is, your consumers do like that, right? If these solutions were free, everyone would have them. So price does matter. Um, we when you look at like that 1 and 2% compound inflation, it's going to soften that premium for you if you're looking for that. And it does qualify in for partnership in 20 some states. I want to talk about this FIB. I'll try to scoot things along so we have time for questions at the end. But with our FIB, that flexible increase benefit, I think of it as a pay as you go type of thing. So um, if you elect the increase, it's going to increase your contract by 5% compound annually. You don't have to prove insurability when you take the increase, and as long as you're not on claim, and I'll get to the deal on claim in just a second. This is a strength, huge strength for us. You don't have to take the offer every year. It's either 5% or it's 0. When you take the 5%, your premium is going to increase on a schedule uh, for the year that you're based on the age you are at the time of the increase. But it's just that portion, just the growth that you're paying the difference on, as far as the age goes. Um, you don't have to take the increase every year. If you decline the increase 3 offers in a row, you will no longer be offered the increase. But when you go on claim, it is automatically going to turn on for you. If you have the FIB as your inflation option, it will automatically turn back on at the time of claim. What do we talk about the premiums? What happens to those premiums when you go on claim? They're waived. So your policy is going to automatically start increasing, but you're not going to have to worry about paying those premiums. We have some very, very nice tools built into our software where like this this based on your client's age, you could take the upgrade every 3rd year. And you can put that right into the software, and it'll show you the output so you know exactly what the benefit is going to be in X number of years, versus the premium. And it's just a fantastic option. So like in this hypothetical, I think a lot of people work better with pictures. I want to tell you a little bit about Mary. So she was 50 years old when she bought her solution. She chose the FIB because it was going to help her manage her budget. The premium increases were going to be dependent on her choice to accept that offer. She knew coming out of the gate, she wanted to take a she wanted to get to 15,000 per month. Over the next 20 years, she accepted 13 offers and then declined the ones in blue. When she was 70 years old, she looked at her monthly maximum and it was at 15,000. And she said to herself, that was my goal, but is it still adequate? She was comfortable with it, so she declined all the other offers. No future offers were offered to her, right? Because she declined 3 in a row. And guess what? At age 80, Mary's health changed. She ends up going on claim. The FIB is automatically going to start growing again. And at 5% compound, of course, her premiums are waived, which is a standard benefit in this solution. And this FIB qualifies for partnership in 26 states as long as you meet the buy-up requirements. Not every state is the same. In some states, you have to take the election every year. In some, you have to do it every 3rd year. Some states, you can stop the growth at age 75. As a follow-up for today, we'll make sure that Marshall has the grid that shows the rules so you know exactly where where this is going to be applicable. All right, let's talk our other additional optional riders, the cash benefit. Some folks will tell you that cash is king at the time of claim, mainly for that informal care. With our solution, we're not going to make you choose between the reimbursement and the cash. This is a reimbursement model. When you buy the cash rider, it's going to pay you 15% of the monthly maximum in a home health care setting, 10% of the monthly maximum if you're in a facility. When you go on claim and you have the cash benefit rider, you're getting the monthly maximum up to whatever the reimbursement chargeable amount is. And then you also get the cash benefit that you can use to spend or choose to spend however you want. For couples, we've got shared care. I think maybe one of the best shared cares in the industry. So like with ours, um it's you borrow from your spouse if you need it. I'll do a hypothetical here. Um he has 3 years, she has 3 years. You have shared care. It works a couple of ways. He goes on claim. He uses all 3 of his years of his policy. He taps into his spouse's policy and uses all 3 of her years. He's done. She can buy up 2 additional years without having to prove insurability. I'm going to pick on him one more time and then I'll be done. Um, Another way that shared care works, for those that are concerned about traditional long-term care, is use it or lose it. And we'll talk about the return of premium benefit in a second here. But you can do this kind of with shared care. You've got that same couple. He passes without using his policy. She's going to inherit she has her 3 years. She's going to inherit his 3 years, and she's only going to pay for her portion of the policy going forward once he passed. If, for example, he goes on claim and uses a year, she's going to inherit the remaining of his policy and again only pay for her portion once he passes. So that's a really nice thing. And of course, remember with our shared care, it has joint waiver built in to the shared care rider. Okay, let's talk about survivorship. I think this is interesting. We don't sell this one a ton. I'll tell you this, it's handy to have on your solution at the time of claim. What it does for you is you buy the survivorship rider. It's a couples rider. So when one of them um, they have a policy in force for 10 years or more, the person passes after having that policy in force for 10 years or more and they're claim free, the 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 premium is paid up. Um, So the surviving spouse does not have to um, stress about they're already going through the hardship of losing their spouse. They don't have to stress about paying a premium on this long-term care benefit. They want to know that this thing is going to be in place and that it's paid up. It hopefully basic common sense will tell you that you can't get survivorship with a 10 pay, right? Obviously, your policy will already be paid up if you buy a 10 pay. So there's absolutely no point in having survivorship on it if you're doing a 10 pay. In our product resource guide, there's a page that shows like what I think it's called a compatibility chart. What riders can you get with the different dynamics? Um, that you'll find helpful too, and I'll make sure you have that as a follow-up for today. As far as accessing the benefits, this is besides shared care, this is one of my very favorite riders. What it's going to do for you is it's going to give your clients access to their benefits on day one, and in a home health care setting. So you trigger the claim with this rider on. You're going to get access to those benefits on day one. Hopefully your ears perk up when I tell you this. Everybody is like, yep, that's a nice benefit. Our waiver of elimination period for home health care rider is going to run about 7%. That is a lot more affordable than some of the other solutions out there that are trying to tack that rider on. 7% roughly to do a waiver of elimination period for home health care. You know the deal with a 10 pay. The rates are guaranteed for the first 5 years, years 6 through 10. The rates are not guaranteed on our solution. Um, the premiums are paid in 10 equal payments. So like you can't do an FIB with a 10 pay, because on an FIB, your rates are going to be changing, right? So that's something to consider. Um, and yeah, I think that's all I can tell you about the 10 pay. All right. Non-forfeiture. I dove into this a little bit early. We're talking about Washington, and I got my wires crossed. The non-forfeiture rider is a rider. It's very inexpensive, and this is when, if you're, these policies. Here's the deal: traditional long-term care policies, they just don't lapse. The lapse ratio on these things is very, very, very low, and it the thing is, Washington, or CARES Act, excuse me, it- we weren't 100% sure um, how how those policies were going to stay on the books. So we did see more of the non-forfeiture riders sold. In those types of situations, the cost is exceptionally reasonable, 8%. I think that while I'm not a huge fan of it, for certain clients, it might be a good idea. With our return of premium option, it's gonna be paid out at that point of death minus any claim. What makes our solution, this rider, a little bit more affordable is that you have to have the policy in force 10 years before that death to get the at death minus claim. To get that return of premium back at the point of death minus claim, the policy has to be in force 10 years or more. All right, let's keep rocking and rolling. Discounts, discounts, discounts. We have them 10% for a preferred health discount. We have a couples discount of 20%. If only one applies, it is a 5% discount. And without spilling the beans, we have a care forward linked benefit solution. We have a traditional solution. Think about this. With our solution, if, for example, she wants traditional long-term care, what we're showing you today, and he wants a linked benefit solution, you get the full spousal discount. That's a really nice deal. It doesn't come up every day necessarily, but keep that tucked in your back pocket, because it's nice to have that option available. Um, with our couple definition, who is a couple? I keep talking about he and she, and to be real clear, we honor a same-sex partner. Anybody that's married is a couple, or if you're a civil union or domestic partners that have a valid certificate or license by the state, um, it can be two individuals that are together 3 years or more in a committed relationship as partners. But it can also be family members that are committed to sharing expenses. They're not married, and if they are family members, they need to belong to the same generation. So you can't do a mom and a daughter and get a couple's discount, but you could do siblings, absolutely. So where does Thrivent fit? We talked about that couple's discount at 20%. We've got the The return of premium option which is a nice little option, because it's priced at where you have to have it enforced 10 years or more. It's going to be affordable. We look fantastic in those younger age brackets. um, we have very competitive on a 5 year, and I'll tell you this, the biggest bucket of a segment being sold is technically that 3 year with shared care. And it's very, very competitive, but we look good on a 5 as well. Um, I'm going to say those high net worth clients. Um, I just realized I forgot to mention something pretty important. I called out our how much and how long up to the 1500 or 15,000 a month up to an 8 year duration. Um, if you tack shared care onto that, for your high net worth clients, um, you're not going to be limited to your benefit there. You can go the full 15,000, the full 8 year duration with shared care if you want. Um, if you are rated up to a class 1 or class 2, you cannot get shared care and you cannot get the first day home care rider. Okay, it'll give you the monthly benefit, it'll give you the duration. We will not do shared care or first day home care if you're rated up to a class 1 or a class 2. We've got a 10 pay available, um, where carrier strength is important. If you've been in the industry long, you will know the best way to retain your client base is to give them a solution that is it's gonna be able to pay their claims. And they have that A++ rating. Uh, you know, the Comdex, of course. We had talked about at the beginning of the call, carrier strength should be important always, right? You want to take care of your clients. Um, and then, of course, I could do an entire section on our underwriting niches. Uh, you got a prequal. If I like things black and white, a lot of times, it's if you want to pick up an underwriting guide, it's a comprehensive guide. It's gonna show both our traditional solution and our care forward solution on how we're going to underwrite for each of those with each of the different conditions listed in there. Plus, you can pre-qual anytime. We'll make sure you have an underwriting guide if you'd like one. Um, what you'll find as you pre-qual, our stability periods might be a little longer for certain conditions, but we will also take things like diabetes. We don't look, we don't knock you out, I should say, for insulin use. We will go up to an 8.5 for the A1C. Um, I really shouldn't even get too deep into the weeds on our underwriting, but like cancer is a biggie. I would tell you that uh, look at the stability periods and the stage, and it might be an option for your client. Um, it you'll certainly find with a lot of them, it is a longer stability period. Um, for some of those things that cause claims, if you look at the top reasons for claims, we're tough on comorbids, real tough. So if you've got that diabetic that had a stroke and neuropathy, um, you're not gonna find success with this. To be crystal clear on that. All right, let's talk about our access and such. We are for traditional long-term care. If you're already using iPipeline, the IGO platform, this should be pretty easy. Um, we're slightly different with our software in that when you go into our software through this platform, it's actually going to pre-populate the application with like the client's name, their date of birth, their state. It's gonna plug in the benefits that you applied for from the quote. It'll partially fill out your personal worksheet. Um, to get to that technology, it is when you get to the e-app, you might think it's a little, there's a lot there. And it's true. Hopefully, as we move along, I can do a demo on our e-app. We see far less delays with um, like information accidentally being plugged in wrong benefits, that type of thing. You know, we launched our e-app. We launched our e-app for long-term care on the third party side of the house in like February of 2020. Very late to the game on an e-app, but we weren't in third party working with folks like you, not career. We didn't launch that until we got serious about it in like the fall of 2019. It took a little bit to get an e-app stood up. You can absolutely take a paper app. You can, and you get that through Forms Pipe. If you want. When you submit your first application, specifically on an e-app, you have to have a writing number with Thrivent. It's going to be like an F0, 5 more digits. You cannot submit your application without a writing number. You came this far, you don't want to put, you could put my writing number in there. No. Put your producer code in there um, so that so that you can get paid on it. That is really, really important. I want to take one more second. When you're working in we have 4 fraternal states that that you need to have a fraternal license in. Those states are Connecticut, Delaware, Massachusetts, and New Mexico. If you're writing business in one of those 4 states, or any of those 4 states, you have to obtain a fraternal license so that you can write in in any of those 4 states. That's different, right? You need to do fraternal training, which is part of the when you get contracted, when you get a writing number with Thrivent, you'll go through fraternal training. Not the same as a fraternal license. The fraternal license is a very simple thing. You just buy a line of authority. Yeah, that's really not difficult. In our software, we have a cost to care breakdown. So, you know, if you like having that, it's built into the software. The quoting software I'm saying. We also, here's just a quick look at that FIB. One of the things that you can do with it is show, hey, I want this to grow every 3rd year. And it'll change the output for you. And then you can show the client what the benefit's going to do versus the premium. How do we compete on price? Well, we took a look at the biggest names in the industry, A+ or higher solutions. And as you can see, you know, you got 2 here that are only available through captive distribution. And then Mutual and Thrivent are on the independent space with that A+ rating. Now, in this scenario, we just did a 57-year-old couple. We did standard health. And, you know, trying to compare apples for apples, we took a $4,500 a month, 3-year, 3% compound we everything else pretty much equal. You can see that we are sitting just fine as far as the pricing goes with the competition. Having a little confidence in the price, I think it certainly helps. Um, in 2021, we've had growth for the last 5 years on this solution. In 2021, though, we had 37% growth on our traditional solution. In 2022, it was 13% growth. And you know, people are certainly getting a lot more familiar with it and comfortable with it. Let's talk about the Christian requirement. How are you going to get into it? So we know that Thrivent is a fraternal organization. We have a common bond to serve Christians. There is one and only one Christian related question on the application. It is one of the first questions on the application, but I would strongly advise you don't want to wait to the point of the app to verify if a person is Christian. Here's the question. They have to mark a box. I am a Christian seeking to live out my faith, or I am the spouse of a Christian who seeks to live out his or her faith. That is the question. When you mark yes to one of those, you've met the Christian question. That is it. We're not going to run anybody down, making sure that you're going to church or what you're putting in the offering. I think that we live in an experience-driven world. You know, the eligibility for this solution is not based only on being a Christian, but it is the basis for membership requirement, and that membership requirement is part of the application. Because it's worded in a way where you can be a spouse of a Christian, that does open it up to mixed faith marriages. And, you know, so that hopefully will make it a little easier. Here's what I would tell you. Leverage the proven positioning statement if you're not sure. This is a great solution to have on your shelf. So, and I've personally used this. I have a few different solutions that we can discuss. One that I would like to present is with a fraternal benefit organization called Thrivent. They are a top-rated financial services organization that was formed to serve Christians. I don't know if that's an option for you, and if it's not, that's okay. We have a few other options that we can discuss. And then stop talking, right? Stop. Just let them tell you, let them respond. They'll tell you point blank, yeah, that's fine, or no, that's not for me. What else do you have? We do not ever want to put you in a position of defense. So I would strongly recommend, before you even show the quote, verify that they are comfortable with this solution.
Melissa?
Melanie, yes.
Melanie, sorry. Melanie, I'm correct, aren't I, in saying that you do not have to be a Christian to sell this product, right?
Correct.
Okay.
Yeah, that was my very next line. On a related note, you have to be a Christian or married to a Christian to have this solution. You do not have to be a Christian to sell this solution. You can absolutely get appointed. Um, Faith can be very personal for folks. I mean, some of our biggest producers across the country uh, do not um, do not are not Christian, and don't you ever feel like you need to apologize for that. We'll leave the judging up to the good Lord. The thing is, this is our structure, and to be eligible for the solution, you just have to attest to this question. And we'll make sure that you have this as well. I want to open it up to any other questions that you might have. I see I've got just a couple of minutes left. What other questions might you have today? We have some pretty good support pieces that I think you'll like. I hope you feel like uh, this is a benefit-rich solution from a financially strong, very stable insurer. Um, you wanna think about, our policyholders should feel good about working with us. We're doing good for our communities. Um, I absolutely want to thank you for taking time to learn about this solution. I do know I tend to get windy from time to time. Tomorrow we're going to do a deep dive on our new Care Forward linked benefit solution. Um, we absolutely appreciate you working with us, and hope to say this is the beginning of a great relationship.
Great. Thank you, Melanie. I learned a couple of things today. I didn't know about the 4 states that you had to have a particular license, a fraternal license. I'd never heard of that. And also, just I didn't know you had to have well, it makes sense you had to have a right number. There was one other thing that there's so many distinctives that you have, and I will just reiterate what Melanie said, that I have found under 55, they're very competitive. You are Thrivent's very competitive for younger clients, and particularly those that want a ROP. The fact that it doesn't cover the first 10 years, or if you die in the first 10 years, it doesn't pay. For people that want to return a premium, that is a good option to show folks, because it's going to come in, as Melanie attested to, price matters. That's one of many considerations, and but it's going to be a lower way to get return of premium. So thank you for tuning in. I don't see any questions or hear any. So be sure to come in tomorrow, same time, 9 o'clock Eastern time, and Melanie will go over their Care Forward solution, which is a hybrid, a life plus long-term care extension product that is like the traditional, has very robust benefits and unique distinctions that they offer. So you'll want to tune in for that. Again, Melanie, thank you.
Yes, thank you. Take care now.
All right. See you tomorrow.
Bye.
Bye now.
Thank you. Thank you. Thanks,
Yep, thank
Marshall.
you.
Thanks, Melanie.
Thank you, Bob.